All right, my friends, our next skills practice involves discontinued operations. So they tell us we're going to have a trial balance containing the income statement and general ledger accounts for a company called Frenchy Inc. And as of right now, they have three reportable segments: food, beverage, and packaging. But during the current year, Frenchy made the decision, here we go, to sell the packaging component of its business. So now the discontinued rules apply. So assuming that we're actively trying to locate a buyer, the sale is imminent within the next year, then the discontinued rules are going to apply. So they tell us the sale is expected to take place in the next fiscal year. So now remember, that income statement is going to have your core business you're operating, your unusual or infrequent. We'll then have income from continuing operations before tax, tax expense, income from continuing operations after tax, and then we'll have our discontinued operation. The reason it has to be moved down below: predictive value, highly irregular. We've never sold this component before, we can never sell it again. So we're gonna have to list below, remember, potentially three calculations. Number one, is it impaired? And then the gain or loss on operations to the date of sale, and then the ultimate gain or loss on sale. And remember, all that is going to have to be reported down below: discontinued operations, net of tax. And don't forget net of tax, and then we'll have our bottom line net income. So Frenchy conducted impairment testing and determined that the packaging segment, goods, not impaired. So we don't have to do one of those three calculations. So what I'm going to do is walk you through the numbers, see the three individual components, consolidate, add all three together, and then we'll back out from that the packaging division that's being sold off. So let's do it. All right, my friends, so here we go. We've got all components listed for Frenchy Inc. So we have our trial balance. So the sales revenue is going to be the sum of the sales revenue for the three separate components, as we're going to see. We back out our returns. We have our cost of goods sold, freight out, salary, commission, so on and so forth. So this is for all three components. Let's just see one at a time now. If we take a look at the various components, okay, we've got the food. That is not being discontinued, so that's going to be staying with us. Then we have beverage. That is not being sold off. That's staying with us. Lastly, we have our packaging. So obviously the packaging, the one on the far right, is the one that will separately be listed down below as a discontinued operation. For right now, what you're looking at on the screen is, well, what if we don't sell off the packaging? Then all three of these are going to be combined. So then our trial balance for all components is exactly as it's shown here. So the sales revenue, obviously the 725, for example, if you add up the 400, the 250, the 75, thus you have your total sales revenue of 725. Your returns, the 8, the 10, the 3, so on and so forth. Okay, so for right now, all components, if we weren't selling off packaging, we would then create our income statement, balance sheet, statement of cash flow, looking at all three entities. But when we prepare our income statement and we sell off packaging, we're going to have to now isolate all those accounts for packaging and list them within discontinued operations. And that's what we'll do next. Okay, so one more time, guys, we got our trial balance. Not going to balance though, to just note we only have our income statement accounts here. So we've got all our debits, our expenses and losses. We have our credits, our revenues and gains for all components. And then if we break it down by component, so for example, we're going to be discontinuing the packaging segment. When we discontinue the packaging segment, we're going to lose all those debits, expenses and losses of 63.1. We're going to lose all those revenues of gain, the 78.5. So the profit contributed from packaging, 15.4, will be eliminated. That's going to be moved to discontinued operation. But before we do that, let's just review. If we were going to take this information, combine it, all we're doing is taking the 400, the 250, the 75, we're going to add up and get our total sales. But then remember, top line on an income statement is net sales. So we're going to back out the 8, the 10, and the 3, the 21,000. So when we do for all three components with no discontinued operation, okay, we've got the 725,000. Okay, that's going to be our total sales, gross, minus the 21,000. And if you take the 725 minus that 21,000, there's for all three components without any discontinued operation, all three components together, combined sales of 704. The cost of goods sold, the 360, well, that's the sum of the 210, the 120, the 30, obviously 360,000, all three entities. Gross profit, 344, SG&A, adding across. We then have our income from operations. We then have other revenues and gains. We then have income before taxes, income tax expense, net income. Please notice, there's no income from continuing operations just yet. If we're not discontinuing the packaging division, then this is how our income statement would look for Frenchy Inc. But watch now, when we take the packaging, We're going to take this now and basically move all this information down below. But remember, materiality, we don't want to overwhelm people with details. So what we're going to do, now that it's a discontinued operation, what we're going to show is what turned out to be the profit from the packaging division, $15,400. We're simply going to report that as a discontinued operation, net of tax. Alrighty, so now let's take a look one more time. Here's our income statement for all three components combined. Don't worry about the numbers so much. Just focus high level. Here's our format, and we have all three components combined. Now, what if we segregate Frenchie Inc., and now we just have two of the three, the food and the beverage. Remember, we're selling the packaging. So for example, where did we get the $632,000 from? Well, that $632,000 would be the sum of the food and the beverage, the 400 plus the 250, the 650 minus the 18,000, the sales returns of 8 and 10. So now we're excluding packaging. So when we have a discontinued operation, now we're just combining two of the three components. We just have the sales revenue, the net sales for the two divisions that we're keeping. Cost of goods sold, that 330, just one more time, where are we getting that 330? That's the 210 for food plus the 120 for the beverage, 330, and so on and so on. But notice how the titles change, and this is really what I want to emphasize with you guys. So we still have sales revenue minus cost of goods sold, SG&A, income from now. That's going to be income from operations from your core business, category number 1. Then we have our other revenues and gains or other expenses and losses, giving us, look, it's in red now, income from continuing operations after tax. That puts the reader of the financial statement on notice that, hey, there's got to be a discontinued operation. If we didn't discontinue the operation, notice that line item's called income before taxes. Now we're calling it income from continuing operations before tax. Then we show our tax expense just for those two components, income from continuing operations, therefore after tax. Now, do you all see the discontinued operation? That's $15,400. And by the way, that's already net of tax. Just as an FYI, that $15,400, if you go back up here, our check figures, if you take all the debits, expenses, and losses, all your revenues and gains, the difference is $15,400. And one of those line items was already income tax expense. So that $15,400 is already net of tax. So we take all that information, and with a discontinued operation, separately reported, right? So we have our income tax expense, income from continuing operations after tax, and then a line item, discontinued operations, which we know is reported net of tax. Then we have our income from discontinued operations, $15,400 again, already net of tax. And therein lies our net income, $31,650. If you notice, the $31,650 and the $31,650 are identical. The difference is we've taken that packaging division and moved it all down below to put the world on notice. Hey, when you're trying to predict future performance, you better exclude the sales, the revenue, the expenses, the losses from that particular division, because it's not going to recur in the future because we plan on selling it off within the next year. So that's at a high level. Don't worry too much about the numbers. I really just wanted to emphasize the format. Now we'll move into an example, but instead of selling, ironically, when I looked at this, I said, why did they choose to sell packaging, right? So if you look at the packaging, they actually had a profit after tax of $15,400. So it looked to me that if they're going to sell off anything, they might want to sell off the beverage, right? Because that has a loss of $1,750. So now we'll go through and actually focus in on the numbers, but we'll keep the food and the packaging. Now we're going to sell off the beverage.